Thank you. Thank you. Can you hear me okay, sir?
Yes.
Okay. Good afternoon. I appreciate you all inviting me on. I'm excited. I'm always excited to teach and educate everyone about finances and how money works because I think the game of money is a game. And if you're not taught the rules of the game, how can you play the game and win? So I think it's important that we understand the game of money. Can you control or can I control? You can go to the next slide. You have the power to become financially independent. And my thing is, you don't have to earn a six-figure income to become financially independent. You just have to have the right tools. You don't have to have a high salary job. You don't have to receive a large inheritance or win the lottery. You just have to take what you have and have a budget and have a plan. I call it a financial game plan is like a GPS. You are where you are, and then you have a location of where you want to go. You have a desire and goal of where you want to go. And it's a job of a financial advisor such as myself to help you get to that place that you want to go. You may have some detours, you may have some rerouting in there, but at the end of the day, we take where you are and then we get to where you want to go. The biggest thing you have to do is take control of where you are right now. And that's just understanding where you are. I'm gonna show you this screen at the beginning and I'm gonna show you it again at the end. It's just talking about goals and where you are right now and then where you are at the end of this presentation. I hope you'll have a better idea of how to get your goals in place, how to prioritize, creating a timeline, and then understanding how much money you may need to save. The first thing we're going to talk about is, you can go to the next screen, is budgeting. Sometimes people think budgeting is being trusting yourself of the things that you are not supposed to have. When budgeting is simply creating a plan and looking at ways of how you can free up money. During the course of a day, week, or a month, there's oftentimes that we spend money on things that may not be necessarily important at that time. But as long as we have a plan in place, we can put those steps in place to create something to free up money for us to put a plan in place to maybe have wealth, put in a wealth building plan. The first step that you want to do when you're creating a budget is to look at where your money's going. If you look at this step one, these are the 5 areas that your money should be going to in the course of a month. Household debt. Now, it doesn't, your percentages may be different. Household debt, living expenses, taxes, insurance, savings, and investments. We hope that at some point in time, the savings investment piece will get a little bit bigger. Your living expenses will go down some, and your household debt will go down some. My goal is to help you get that household debt down, reduce it down, and put more into the savings and investments. You can keep going. So here's the information that you need to start gathering up how to do a budget. How much money is coming in right now? How much money do you have coming into your household? How much is going out? A lot of times when people see this on paper, it becomes a real eye opener for them. So here's how you get started. You take and you gather up everything that you have, bank statements, investment accounts, utility bills, anything that you're spending money on, also all down to the amount that you spend on coffee every week or that you spend eating out every week. Make sure you get everything and put it all in one place so that we can take a look at it. Then look at all your sources of income. How much do you have coming into your household? If from every aspect, it could be salary, it could be Social Security, it could be rental income, any type of investments that you're getting dividends from. So those are the 2 things that you need to gather for your budget. And you want to be honest with yourself. Make sure you write it down. When I say everything that you're spending, everything that you're spending. And if you do that for about a week, you'll kind of get an idea of, we know what your bills are, but you'll get an idea of where you're spending little pockets of money. So as you create that list of expenses, this is everything, because you know if you have children in college, they're still an expense. If you have, make sure you put down entertainment. I always tell people to budget for entertainment. You don't want to just work hard all your life and just pay bills. You want to make sure you budget for entertainment, budget for travel. If you want to go on vacation, budget for that also. Now that you get all that information together, we're going to put together a worksheet to help you get started to build a budget. And if you look at the worksheet on the page on the screen, you'll see where it says monthly expenses. It's got your utilities, it's got your transportation, it's got your insurance, and it's got debt payments. One thing that people don't think about sometimes when they're thinking about transportation, other than the car payment and the gas and the car insurance, you also need to budget for maintenance because you get an oil change. You have to pay your tags every year. Those things are important. If you're in a bigger city and you're paying tolls, those are things that you want to put into this budget. Then you look at the other side and it's got food and your family purchases. If you're paying for childcare, if you're paying for any type of fees at school, your personal care, your hair appointments, any prescription medication, toiletries. I mean, everything should go into this budget because you're spending that money. And like I said, sometimes before you put it on the paper, you don't even realize that you're spending that much money. Now that you put this list together, you're going to separate the expenses in two categories. There's a category called fixed expenses, and there's a category called variable expenses. And the fixed expenses are going to be things that stay the same month in and month out, and they're necessarily for you to live. The variable expenses change from month to month. How much you spend on groceries, how much you spend on gas, how much you spend on dining out, how much you spend on if you're giving somebody, if it's a birthday or if it's an anniversary. Those little things add up, and we don't think about them as we're thinking about spending money because somebody's having a birthday. Oh, you got to get them a card. You got to get a gift. Somebody's having an anniversary. You got to get them a gift. So those things add up, but they're variables. They might not be every month, but they're also things that you need to budget for. Step 4, total up your monthly income. You want to add that part up. Now we've gotten our expenses done. We've gotten our monthly income. And if your income is greater than your expense total, that's awesome. You can take that money and start putting it towards a retirement plan. Or we can put it into what I'm going to show you in a few minutes is a debt stacking plan. If your expenses are greater than your income, then we need to start looking into that budget, digging into that budget a little bit deeper and saying, where can we free up some money? Maybe I don't need all of those subscription services that I have. Maybe I don't need to get coffee 5 days. Maybe I'll get it 2 days. So we can start looking at ways to make some changes. So if you got income is greater, that's great. If your income is less, we can work on that. Step 5 is going to be make some adjustments. You're in control of this. This is the things that if you want to really get a control of your budget, you'll start to make some adjustments as to what you're earning and what you're spending. Because we want to make sure that we're not overspending. We're not living above our means. You have a means as to how much you're going to have coming in. You don't want to live above that means. So we talked about this, find some areas, take a look at the variable expenses first. That's the places where you can find the ways to cut back. You're not going to be able to cut back on your mortgage payment. You're not going to be able to cut back on your car payment. Those are things that are fixed that you're not going to be able to change. But these variable expenses are areas that you can look at to make a change to cut back on. You want to make sure you review this budget monthly. You stay on track. It's one thing to put a budget in place. It's another thing to put that budget in place and then just go put it down on the shelf and never go back and look at it. Those things are going to be tweaking every month until you get it down to, okay, I've got a good idea. I got a good grip on my budget. Take a few minutes to compare your actual monthly expenses with what you created in the budget. So you've got a budget and then you got what you're actually spending. Take a look at both of those and make sure that they're kind of on par and it can show you areas that you need to tweak. If you say you're going to budget $200 for gas and you're spending $250 every month, then maybe you need to tweak that area and increase that budget for gas. And vice versa, if you're spending less, then you can tweak that area and put that $50. If it's 150, you can put that someplace else. So those are the reasons why you want to make sure that you're constantly looking at this until you can get it down to a good figure, a good amount. Now, once we get that part of budgeting, we're going to talk about paying off your debt. Debt in this country is a really, really big deal. And there's two types of debt: revolving debt and there's fixed debt. Revolving debt is going to cause you to create more interest payments. If you had a revolving debt at 17,000 at 18%, those credit cards, and you're paying $595 a month, you're going to pay, if you took just and paid the minimum interest on it, you'd pay 12 minimum payment on it, you'd pay $12,500 in interest. It'd take you 17 years and 2 months to pay it off. And you think about that, you go to the store, you go to the department store, you go to the mall, you go to the outlets, and you buy something that may cost you $125. Well, actually, how much money you're actually paying for that when you're buying that for $125, unless you're the type to pay off your credit cards at the end of the month, how much you're actually paying for that $125 item that you purchased at the store. And then we have fixed debt. And we take that same $17,000 and we're putting it in 18% rate, but it's fixed every month. You're only going to pay, it take 3 years and 2 months to pay it off. And that's going to be only $5,300 in interest paid. So what I teach my clients is I teach them to debt stack. And this is a disciplined way of paying off debt. You have, we stack all your debt into one category. And we take the interest rate of the highest credit card and we pay that one off first. And in this example, you're paying the retail card off for $220 and you get that paid off. Now your total amount coming out of your household expenses right now is $2,720. We take that $220 and we add it to the next credit card, and instead of paying $353, we're paying $573. And then when so on, we take that $573, move it to the car loan. And then you take the money and move it to the next credit card, because maybe that's a credit card that doesn't have a high interest. And then we eventually move it to the mortgage and we pay our mortgage off. So this is called debt stacking. We're debt stacking, taking one card, you're using the same amount of money that's coming out. Pay this debt off, you'll see on the next slide that how debt stacking works in terms of the interest rate. So this payoff with the interest rate without debt stacking was 24 years. And interest pay was $212,000. The monthly payment was still $2,720. With debt stacking, 15 years sooner, 9 years avoided, $82,000 interest paid, and using the same $2,720. So there's a difference in amount of interest paid. You know, a lot of times people say, how much have I got to pay per month? Well, it's not necessarily how much you pay per month, it's how much are you going to pay overall in interest. Because you go buy a car and the car costs you $52,000 out the door, how much are you going to pay for that car? You got to pay interest. So it's not always, the question shouldn't be how much have I got to pay per month, is how much am I going to pay overall for this item or this product that I'm buying. Saving. So, you know, we always talk about saving money. And there's a lot of times that we do need to save money. We need to save money because it's healthy for us to have short-term goals. It's healthy for us. We can put it away. You want to help your money to grow. Unless you're independently wealthy, setting aside money today to see that you have enough money for years down the road by starting a retirement fund is not an option, it's mandatory. Because we know that in this country, we cannot rely on Social Security. I never put it into the equation because we don't honestly know what's going to happen with Social Security. So unless you got somebody that left you a big lump sum of money, or you go out and play the lottery and win the lottery, you're not independently wealthy. So it's important that we start setting aside money to make sure that we have some money down the road. 3 areas that, and this is just something that I want you, if you had a pen and paper, this is interesting. This was interesting to me. It's not what you earn, it's what you keep. So I said over the last 10 years of working, because when you start working early, you may not be making as much money, or you spending a lot of money because we're not disciplined early. But take the amount of income, the average amount of income that you've made in the last 10 years, and put it in by letter A. Take that number, multiply it times 10. That tells you how much you've earned in income in the last 10 years. Then now think about this. How much of personal savings do you have? 401ks, Roth IRAs, deferred comp, savings, CDs, wherever you get under your mattress, wherever you have it, put that in D. And you don't have to do this right now, but it'll be interesting to see if you divide D by C, that's the percentage of income saved that you've made in the last 10 years. So it's interesting. It's not what you earn, it's what you keep. And like I said at the beginning, you don't have to be making 6 figures to start saving money and putting it towards a wealth building plan or retirement plan. One important concept, you've probably heard this before, pay yourself first. And what does that look like? Okay, there's 3 accounts that you should set up. The first account, you should have an emergency fund. Emergencies happen. Emergencies happen, and there are emergencies if you don't have any money. If you have money saved, there's situations, because we handle situations. Emergencies, we've got to make arrangements for. So in an emergency account, you should have at the minimum 3 months of your monthly income, expenses. We talked about that earlier as we were working on our budget. We already know, if we've gone through the process, of what our monthly expenses are, because we've done our budget, we've readjusted it, we know what our expenses are. So now if your monthly expenses are $5,000, then you should have a savings account, which is an emergency account of $15,000, because if God forbid if something happens and you can't work and you don't have any PTO, or they will give you you can stay on the job, you can keep your job, but that doesn't mean they're going to keep paying you. So you want to have an emergency account. Things happen at your house, something floods, or something happens to the car, and you've got somewhere that you can go, and you don't have to go to a person because you are your own bank. The next one is a short-term account. You'll need about 6 months worth of income. Say you say down the road, Trey, I want to buy a boat, I want to buy a yacht, or I want to buy a house, another house in investment property on an island somewhere. Well, we'll start saving for that. We'll start putting into a shorter term account, because we know it's an account that you're going to go and get the money from in maybe 3 to 5 years, maybe your horizon. And then the last one, which is I think one of the most important ones, is a wealth building account. You have enough money to save to retire in dignity and enjoy your life. Financial independence. That's what we want to create with this account, is financial independence. And financial independence is simply having enough money accumulated that you don't have to go out and work, and you can pay your expenses. That's where we want to all get to, is financial independence. So we've been taught to save money, save money, save money. How many times has our family told us to invest money? And so not just saving it, but putting it into an account where it's going to actually build some wealth for us. So that's equity investments, that's mutual funds, that's different types of accounts that we can put our money in. One question on here, how much would an average senior spend on healthcare related expenses in retirement? On the average, a senior may spend $157,000 in retirement. So that's important, because as we get older, we need money. So we want to make sure, not just for healthcare, but for our living expenses, we want to make sure we have enough money in place, because you don't want to retire and then have to go back to work because you don't have enough money to live on. So we want to talk about, the next thing we want to talk about is investing. Not just saving the money, but investing the money, putting it into the right places. Become an owner, not a loaner. When we put our money in the bank takes your money and puts it in, they put it into the global economy. They put it into funds. They make about 9 to 12% on your money. But what they give you is about 1 to 1.5 or 0.02% on your money. Is that fair? No. So if you know this concept, you can become the owner of your money instead of loaning it to the bank and letting the bank use your money and make a profit off of it and giving you mere pennies. What the bank gives you in most accounts, you can take your money, put it on a mattress, takes a little piggy bank and throw your change, spare change in there, and that's about how much money they give you in interest from the bank. So we teach clients to bypass the middleman, go past the bank. You don't need the bank other than we need banks to keep our expenses in, but not to put our investments in. So if you deposit $10,000 at 1.5% interest at your local bank, you'll earn $150 for the year. You pay $33 in taxes on that. So you minus $33, so your net earnings are $117. Your resulting balance will be $10,117. But if the inflation is 5%, your buying power is reduced down to $9,600. So you've actually lost money by putting it into the bank because you don't have the same buying power as you would with inflation, without inflation. So remember, it's not the money that you have, it's where you're putting the money. So you got to see how much money your money can buy. There's always going to be, with the uncertainty that we have, it's really time for you to take control and not rely on other sources to fund or protect your retirement. We don't know what's going to happen with Social Security. You know, if with every election that comes up, and I'm not telling you who to vote for, I'm not political, but I'm saying with every election, there could be changes to our Social Security. We just don't know. We know that we have company pensions, we know that we have health plans, and we have personal savings. So this stool is going to always be wobbly because we just don't know what's going to happen. We don't control the company. If you have a pension with the company, you don't necessarily control that pension. And then we have to pay for our own health when we stop working. So this is an important rule that for you to understand where to put your money in terms of, it's a banking rule that we just never, you may have heard of it, you may not have heard of it. And the rule simply says, if you take the interest rate that you get and you divide it into 72, it's going to tell you how long it takes your money to double. Well, I just said that the bank only gives you about 1%, maybe 1%. But hypothetically, if they gave you 3% and you put a $10,000 investment in there, it would take 24 years for your money to double. If you put it in an investment about 6%, it takes about 12 years, and 12%, it takes about 6 years. So I'm not sure about you, but I know me, I don't want to wait 24 years for my money to double. I don't necessarily have 24 more years. If you're young, you might have that kind of time, but why not put your money where you can get the most bang for your buck? And that's between 9 and 12%. The 9% will be about 8 years, 12% will be about 6 years. This is important because you would know where to put the money in. Because if you start looking at your investments that you have right now, and you look at them and you say, man, they're only getting about 4.5%. They advertise this at the bank. Get a CD for 5%. Well, that money I just told you, they're putting that money into the global economy and they're getting 12% and they're giving you 5%. So why can't you take your money and put it into the economy yourself and get about 12%? The rate of return is important. If a parent is investing $1,000 at birth for a child, a one-time investment, 3%, look at what, if they put this in there and they never put another dime in there at age 67, there will be about $7,000 in that 3%. If it's 6%, about $55,000, and at 9%, about $400,000. So even with children, all my nieces and nephews, I start teaching them these concepts at 18, so they can start investing money for themselves versus just because they spend money. They invest about $25 a month, each one of them, because they waste $25 a month. So it's important to get started early. And this is what this example is. It's about the rate of return and starting investments early. Just a little bit more makes a big difference. Take a look at the difference between $20 a month and $100 a month. In 10 years, if you contributed $20 a month to hypothetically 9%, in 10 years, you'd have $3,900. If you put $100 in, $19,500, and so on. At 30 years old, you'd have $184,000 and almost $185,000 if you put $100 away, starting at age 10 for 20 years. So now I'm going to talk to you about the 4 places where to start putting your money if you were to start looking at retirement accounts. There's a difference between a deductibility and deferrability. A tax deduction is the amount of money you can subtract from your gross income before you calculate taxes. The more you can reduce that gross income, the less amount you pay in income taxes. So it pays to have deductions. That's for a tax advisor to give you more information about your personal tax situation. A deferral means that you postpone paying current taxes to a later date in the future. So the great thing about returning taxes is when you go to take it out, the expectation is you're at a lower tax bracket, so you will actually pay less in taxes. That's one of the reasons why we teach people to put money into a place where it's going to be deferred, so that by the time you take it out, you're in a different tax bracket. Which would you prefer? And this is based on individual situations, but there's a few choices when it comes to IRAs, individual retirement accounts. You can have a traditional IRA, which is deductible, or you can have a traditional IRA, which is non-deductible based on your earnings, because those two are based on your earnings. And then you can have a Roth IRA, which is non-deductible. But the good thing about a Roth IRA is you do get the tax deferred earnings. So anything that's in that Roth IRA, you can defer the earnings. And when anything that you take out of there that's earned money, you don't have to pay taxes on it. And everybody's situation is different in terms of what they need and where they are in their financial situation. The benefits of a traditional IRA is that it saves you money by giving you and your spouse the potential to contribute, and it's about $7,000 now off the top of your gross income, which reduces your taxable income. You postpone paying taxes on it until they're withdrawn at a date in the future. And like I said, when you withdraw them in the future, typically your tax bracket will be a little bit lower. A non-traditional IRA, a traditional IRA non-deductible is for people if they're over a certain amount of income, because there are income limits. You may not be able to deduct it from your current tax bill. However, your non-deductible contributions will grow on a tax-deferred basis. And then a Roth IRA contributions are not deductible, but you do receive tax deferral on the earnings and tax-free withdrawals later. And that's important because if you can contribute $7,000 plus another $1,000 for catch-up after the age of 50, and you put the money into a Roth IRA, anything that it grows, money that it grows, you don't have to pay taxes on it. And this is just a slide that talks about when you can take the money out, what happens to that money, tax deferred, non-deductible, tax-free. In a Roth IRA, you can take it out after 5 years. The magical age for retirement withdrawals is 59 and a half. That means you don't have to pay penalties for it to get the money out. If you take it out prior to 59 and a half, you do have to pay some penalties. But if it's a Roth IRA and you've had it for at least 5 years, there are some special circumstances that you could take the money out of a Roth IRA without having to pay penalties. And here again, this is just another way of just another re-emphasis of the rate of return is important. The S&P 500, put it in traditional bonds, 30-day T-bills. You know, back in the day, it was important. My grandmother and my older relatives were always taught, they was like, go get a bond, go get a savings bond for your family and set it up for the kids. Well, that's what they knew at that time. When we know more now, we know that we can put it into an investment for our children and have more return on it, and we can get more money in the long run for our younger people. So you can keep on. Invest in professional management. A mutual fund because people always say, do you invest in stock? Well, not necessarily stock market, because investing in one stock can be very volatile. It can be, if you're not constantly looking at it, it can be something where you can lose money. But what I teach people to do is invest in mutual funds. They are professionally managed. You're the investor, you put money into a mutual fund, and a mutual fund simply a fund, but it's made up of a lot of different stocks. This particular example, this mutual fund had Microsoft in it, it had McDonald's in it, it had Amazon in it, it had Netflix in it, it had Verizon in it. And a mutual fund has different, it may be communication, it may be tech stocks, and it's a combination of stocks that's going to be one fund. It is the manager's responsibility to make sure this fund is making money. So you don't have to, you're not paying to say, okay, every time they move this money, change stocks is in there, I'm paying them money. No, you pay your money into this to have your money professionally managed and in a mutual fund, and not putting money on stocks, unless you're just a day trader and you just like to invest money like that. This is a good place to put your money. And there's three D's of investing: discipline. And discipline goes through, and you'll see discipline in different threads of our lives for a lot of different things. But money is discipline. Diversification. We just talked about not having everything in one stock, putting it in different stocks. And then dollar cost averaging, because over the course of the month, the stock market's going to go up and down, but you want to make sure that that you're in a market where your money is going to be getting the most cost per dollar. So if you look at this and you were to say, do I want to be investor A or do I want to be investor B? Investor A is investing $100 a month, and the market's continuing to go up, 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 up for 6 months. Investor B is in a fluctuating market where the market's going to go, it started at the same price at $10. It's going to go down, and then it's going to come back up by the time it's at the 6-month mark. Which one do you think you'd rather be? Investor A or investor B? You got your answer. We're going to go to the next screen. And if you said investor A, you got $845. If you said investor B, you got $1,259. And the reason why a lot of people choose investor A is they see the shares are going up, 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 and they think, okay, I'm going to keep earning more money. And that is true. However, if you're at the bottom and you're investor B, what happens is when that money goes down, that stock goes down, you're going to actually be buying more shares. So by the time it comes back up, you're going to accumulate more shares. If you look in month 3, month 4, the share cost per share was $2. So this person was able to buy 50 shares in that one particular month. And by the time they got to the end of the 6 months, they had accumulated $125 per share, 125 shares. And the stock price was still back at the same amount that it started at $10, but if they cashed it out, it was going to be $1,259. So when we look at the market, sometimes there's different things that happen in the market. It could be a tsunami, it could be 9/11, it could be the Ukraine war. Something happens to cause the market. You'll see it on the news. The stock market's down today. The stock market's down today. The only way you lose money when the stock market is down is to take your money out. If you let it stay and let it rebound, then it will go back up. But you have to be patient with it to rebound. Now, there's different phases for a person when they're investing, because if you're investing money at between 25 and 40, yes, you have time for your money to go up and down. When you get to be about 40 to 55, you start looking at it a little more critically. When you get to be 55 and older, I call it scared money. Now you're starting to say, okay, I don't have time for this money to bottom out and wait for it to come back up. So we start looking at different ways to put your money in places where it's not going to lose that principle, because you've worked hard at that point in time to get you a certain portfolio added up, and then you don't want to take that money and just let it bottom out. So there's different phases to investing, as well as where we're going to put your money. So are you in an aggressive phase, or are you in a middle phase where you're saying, okay, I've got to start really thinking about when I want to retire? And or you're in the last phases where you want to start turning the spout on and start getting a check from that money. Because at the end of the day, retirement is a money amount. It's not an age. And if you had about $2.5 million in an account right now, we could turn the faucet on and start sending you a check every month, and you don't have to worry about going out to work and earning income. So just remember that. So you can go to the next page. I think you went back. I think you're going back. So we talked about this in the beginning. As you start thinking about how money works, start looking at what are your goals? When do I want to retire? What do I want in the interim, in the short term? What do I want in the future? Because remember, I just said retirement is a money amount, not an age. Write it down so you can get personal, so you can be motivated to achieve this. You can achieve anything you want to achieve. It's just a matter of being disciplined enough to put it into a plan and follow the plan. Which goals are achievable? Which ones are you going to have to work some on? Create a timeline. It'll help you stay on track. And then, how much money do you need to save? That's the key question. That's your financial independence number. It's a FIN number. It's called FIN. It's your financial independence number. Because the last thing you want to do is save a certain amount of money, and then you outlive that money. And then you've got to go back and figure out how I'm going to live, or you're living on a fixed income because you don't have the amount of money saved. So if you do the work now and do the work early and keep being disciplined, you'll have enough money to retire with dignity and not have to go back to work. I believe everybody can do it. There's a path to financial independence. It's a few concepts that I talked about today. There's some other things that I can explain to you a little bit more. I can put together a plan for you that you can help you follow to make sure you get to where you want to go independently financially. You can take control of this right now. If you don't, some of these concepts you've heard before, some of them you may not have heard before, but it's up to you if you'd like to take control of your future. And lastly, I've got a book that I would like to send to you complimentary. It's a How Money Works. It's some of the concepts that I've showed you today, but it goes into more detail. So you can scan this QR code and it'll send you a complimentary copy of How Money Works. It's just a detailed copy of how the money game is. And it goes into a little bit more detail than what I went through today. And then if you want a complimentary financial review and you want me to take a look and see and help you with the GPS of a plan, on that QRS code, when you scan it, there's a place where you can make an appointment with me and sit down with me. I appreciate your time today. I know we have some questions for me.
Yes, ma'am.
Thank you, Cheryl.
So one of the questions is, what are some of the common pitfalls people face when trying to stick to a budget?
One of the pitfalls happens is emergencies happen. And things happen in their life that they have no control over, that they didn't understand they didn't know what's going to happen. The other thing that happens when they're trying to stay on a budget is they want to do what they want to do with the money at that time. They feel like they worked hard for it and say, hey, I've worked hard for this money, and the future is so far away that I can save later. I can do it later. I can put this off for right now because, I've got time. And we think we have time, but time goes by fast. I mean, look at COVID was 2020, and it seems like it was yesterday, but it's been 4 years almost. We're going on 5 years since COVID happened. So time goes by, and 1 week turns into 2, 3 to a month to years, and we're in the same situation or worse because we've waited. So my advice with the budget is just get started today and not wait.
Okay. Can you share some tips for creating like a realistic budget that works for different income levels and lifestyle?
Realistically, I would say take a look at what you are spending. That's the biggest thing, is where you're spending your money. Because like I said, little things you don't even realize. It's kind of like what we eat sometimes. We don't realize what we eat until we do a daily intake of what we're eating. But if you take a week and you write down everywhere you spend money. Because it's not how much money that you make, it's just that we don't want it. If you make $10,000 a month, or if you make $2,000 a month, if you make 10,000, you don't want to spend 12,000. If you make 2,000, you don't want to spend 2,200. So if you make 2,000, we've got to get it to a point where we're only spending 1,800, because we still want to save some of that. Or we making 10,000 and you want to get to a point where you're spending 9,000 or 8,000. So really taking a look at a daily from Sunday to Saturday, where am I spending money? Every time you spend a dime, write it down, put it in a journal, put it in your phone, so that you can get a grip on how much you're really spending. And if you could do that for a whole month, because the days, things change in the course of a week to week, but how much are you spending in a month, so that we get a good idea of where we can cut back, because that's important. It's not so much how much you're bringing in, it's just that we don't want to overspend that. And where can we find ways to put that money, save that money?
Are there any tools or apps that you recommend to help track and manage your finance more efficiently or effectively?
I not necessarily tools. There are some apps out there. I'm just a good old spreadsheet person. I'm a notebook person. I'm old school. Like I like to write stuff down, and I just keep a little notebook for me. I like apps and I think they're great, but you got to go to the app and put it in there. You got to find it in your phone. I mean, people are good with that. But for the people who are not, get you a little notebook from the Dollar Tree. And then you ain't got to get an expensive one. And today is Saturday, August 31st. Today, where did you spend money? And write it down. And that way you can keep track of it. And then I learned something, a long time ago about how you spend. You budget for $200 for leisure, don't overspend that. Once you get to that end of that time for that month, then that's it. That's it for that month. And the discipline of that is up to you, because you've got to have a goal then. If you don't have a goal in place, then you can be like, oh yeah, I'll spend that. But if you got a goal in place and you're serious about it, it's no different than like eating right and trying to lose weight. Anything that we're trying to do in life, and finances is just as important. But we have to have a goal. And if that goal is bigger than us, then we'll make sure that we keep doing the things that we need to do to reach it.
Do I have any questions from anyone in the room? If you could raise your hand. While we're waiting on that, I have one more. For someone new to investing, what strategies do you recommend to get started safely and intelligently?
One of the things I recommend is sitting down with a financial professional such as myself. And the thing about me is I don't charge people to sit down with me, because we work with a lot of middle income families. But the important thing is, how much money do you have in plan and to put in plan in place? Because you may have $25 a month, and people think sometimes they have to have a lot of money to start investing, and you really don't. You just got to get started. Our investments for our mutual funds is $25 a month. Well, most people in their mind, they're thinking you have to have $5,000 to, and there are some companies that will make you start with $5,000. But the important part is, let's get a plan in place and let's get started. And it may help you understand. The thing I do with my clients is I review when they first start investing. I sit down with them quarterly so they can understand what their investments is doing. And part of it is just the education of it. We don't do some things sometimes because we're afraid, because we're not educated. And when we get more educated about it, when you feel more competent about it, you feel more confidence in it. And so the more competent you are, the more confident you will be in investing. I think Jewel had a question.
Yes, Ms. Knight.
Great day. I hope you're doing well. My question is, you alluded to the example with the 1% to the 12%, and you had said that to put that into the economy. You use those words. What does that exactly mean?
The global economy means that we're putting it into a mutual fund. Global economy meaning that we're not putting it all into a tech stock, or putting it all in a communication stock, or putting sometimes it's international stocks, but they're all into it's like the not putting all your eggs in one basket. So the global economy meaning that we're including not just here stocks from this country, but also international stocks. And that's why we have a market manager of money. When you put your money into a mutual fund, you have a manager who manages that. I don't know enough about it to try to say I'm gonna put my money into Microsoft, because then I'll be putting all my money into one basket. But the global economy, meaning not just the United States, but also other countries, because we invest in stocks in other countries. We don't always know it because we don't know exactly what people are investing in. Like your 401k at work. How many people get the 401k? They give you every October, whenever they give you open enrollment, they say, here's your benefits. But they don't really explain what the 401k, where your money goes. And sometimes you have a chance to pick it out. And sometimes you just pick one blanket investment. And so that's when I say global economy, it's not just the United States, but it's economy overall, like tech stocks and communications and different forms of stocks.
Thank you.
Mhm.
There any additional questions? Something in the chat. Okay, we have great presentation. Education is the key. I couldn't agree with you more. Ma'am, did you want to say something before we close out?
I just want to say thank you for the opportunity to talk to you. I'm really big on education. I think that education is the key to understanding how to manage your money. When you get your paycheck, nobody gives you an instruction guide on how to spend that money and then what to do with that money. So it's important that you have a good understanding, because like you say, you could be making a little bit of money, you could be making a lot of money. If you overspend that money, then you're still broke and you're still swimming and you're going in debt. So it's not necessarily how much you're making, it's how you're managing that money that you.
Royal Grand Perfect Matron, did you have any words?
Of course, you know I always got words. You know I always got words. Again, thank you guys so very much. Again, first, I am Ladidra Wright. I'm the Royal Grand Perfect Matron for the Prince Hall Grand Court, Ladies of the Circle of Perfection, here in the jurisdiction of North Carolina. I want to first thank my committee for listening to me and putting my plans into place. I said, this is what I want, and this is who you need to call, and she's going to point us in the right direction. Royal Matron Cheryl Monroe, you know that I love you, I love you, I love you, and there's nothing you can do about it. Our guest speaker, Ms. McMillan, thank you so very much for this very informative information. I just had to go through some of this with a good friend of mine, trying to figure out where to put his money, where to take it out, where to put it at. So again, some of the information that you provided today was very, very informative to me. I don't know about everybody else. I would like to thank all my grand officers that I see here. Alanda, Phyllis, I see April. Of course, my right hand has been so far Royal Grand Principal Conductor Sylvia Little. Thank you so very much. And I know that Angelique is not on today. She did call me. But again, I want to thank you guys. I know that they will have this up on our Facebook page as well as our YouTube subscriptions of you guys. And I'll make sure that I send it out to you again, so that way you can go back and listen to it. I would be remiss if I didn't thank my good friend, Grand Thrice Illustrious Master Marvin Williams, out of the great state of New York. See, I got it right this time, out of New York. Again, thank you so very much, sir. I appreciate
Thank you for having me.
I appreciate you so very much. And Miss Roxanne, I see you over there. I'm so happy to see you as well. Thank you guys so very much. Sylvia, do you have anything, ma'am?
I do not, but I will say to the body, stay tuned for the next seminar.
Yes, because we are busy. We are busy. Again, you guys, if you will, for those who are on here, I know that you've heard me talk about, if you see my good, beautiful voting background back here. As she said, this is a year of the elections. So we want to make sure, we're not telling you who to vote for, but we just want you to vote. So we do have our voter registration ads going out on Facebook as well as the YouTube page. So all you ladies and gentlemen up here, I hope to see you do me a 30 to 45-second ad so that way we can get out the word to vote, because as she said, we don't know what Social Security is going to do, so we can't put all our eggs over there. So we just got to make sure that we're informed. I thank you guys so very much for your time, for joining us today. If there's nothing else, I'm going to turn it back over to Royal Matron Monroe to close us out.
Okay, also, I would like to add to that, if you haven't read 2025, please do so. Did everyone get a picture, a scan, the barcode that was up to get the book?
I'll make sure that I send it back out. So if they'll send it to me, I'll make sure that I email it out to everybody.
Okay, I just wanted to make sure
Because I
everybody.
already did mine.
I'm sure. I want to make sure everybody that was on the call get a chance to get this book, because it is very informative. I would like to thank you all for joining us today, and a special thanks to our guest speaker, Ms. McMillan, for sharing such valuable insights on managing finances, investing smartly, and building long-term financial security. The journey to financial freedom requires careful planning, discipline, execution, and most importantly, continuous learning. Remember, creating a solid budget is the foundation of all financial planning. And with smart investing, efficient management, and strategic savings, you can grow your wealth and secure your future. And don't forget the importance of reducing and eliminating debt as part of your overall strategy. As you leave here today, take these lessons with you and put them into practice. Your financial future is in your hands, and with the right knowledge and tools, you can achieve your goals. Stay committed, stay informed, and continue to build a brighter financial future for yourself and your loved ones. Thank you all, and have a great day.
Thank you so much, Cheryl. Bye, y'all.
Thank
Good day.
you.
Have a blessed weekend.
You too. Bye-bye.
Goodbye. Have a great weekend.
Bye.
Have a great